Welcome back, everybody. I'm Mark Stockets, talking stock markets. Last episode, you learned how to make money using stocks and bonds. This week, we're going to talk about using mutual funds and ETFs. Look, guys, the investment game is a lot like dating, where you need to have multiple partners for diversification. Let's get some simple definitions out of the way. A security is just another word for a stock or bond. A mutual fund is a basket of securities that is professionally managed, meaning a company hires people to pick and choose what investments go inside of that fund. Their idea is that they can outperform the market during the good times and protect you during the bad times. An ETF is also a basket of professionally managed securities, but instead of people picking and choosing what goes in and comes out of that basket, the ETF simply mirrors an index like the S&P 500 or a specific sector of the economy like technology. Mutual funds or ETFs can contain anywhere from 100 to 3,000 individual securities inside of them. And just remember, a security is another way to say stock or bond. There are a few key differences to remember between mutual funds and ETFs. The first major key difference is the cost of owning the mutual fund or ETF. If you remember when I said mutual funds have managers that pick and choose what goes inside and comes out of the investment, well, guess what? You pay for that. With an ETF, because they're simply mirroring an index, there is no active management. There are no people picking and choosing what goes in and what comes out. Therefore, the internal expenses are much less. Active mutual funds make one claim, that they will play offense better for you when the market is going up, and they will play more defense when the market is going down. That's their claim. It's up to you to monitor the performance of these active managers. If you spend a year owning a mutual fund that is actively managed, I'd advise you to check whether or not they made more than the market or whether or not they dipped less than the market. Also remember, for the work involved, the offense and defense, they have a fee. So if you're ever looking at a mutual fund fact sheet, and you can find them on every mutual fund company's website for every fund that they have, check what's called the internal expense ratio. That's how much you pay them. And remember, I said fund fact sheet with a D, not fund fact sheet. Funds for Saturday, when the market's closed. The cost of ETF ownership is generally less than that of an actively managed mutual fund for two very important reasons. One, no fund manager. Two, less or lower transaction fees. At the end of the day, the decision is yours to make, and there are two theories to think about: active versus passive when it comes to mutual funds and ETFs. For the longest time, active management has been the way to go, and you pay the cost for it. The way the market moves today and the way the trends are and what people want out of their investments is definitely a swing toward ETFs. Just remember, investing is serious business, and if you're going to have money in the market and own investments, then you need to pay attention to what you own. And they need to be making sure they're doing what they said they would do. And if they aren't, then it's time to get out. Marry some, date some, dump some. The third major difference between mutual funds and ETF is pricing. ETFs are priced in real time, whereas actively traded mutual funds are not. The reason why they aren't traded in real time is that managers can pick and choose investments every single day. Though they don't always, they need to wait till the end of the day to determine what the price of one share will be tomorrow. All right, everybody, I'm Mark Stockets, and that concludes our Back to the Basics series. You learned about stock markets, exchanges, indexes, stocks, bonds, mutual funds, ETFs. Let us know how we did and what you'd like to see in the comments below. Until next time, I'm Mark Stockets, talking stock markets. Peace.